Welcome to the Markets Mindset. Liquidity is one of the most overused and misunderstood words in trading. People talk about it like it's invisible, complex, or reserved for institutions. The truth is simpler. Liquidity is easy to see on any chart if you know what to look for. Today I'm going to show you a simple, repeatable way to spot liquidity without indicators, without advanced tools, and without guessing. Once you see it, you can't unsee it, and your entries, exits, and patience immediately improve. Let's break it down. What liquidity actually is, in plain English. Liquidity is not volume. It's not market depth. It's not some hidden institutional secret. Liquidity is simply where orders are sitting. Specifically, stop losses, breakout entries, resting orders, emotional positioning. Anywhere a large number of traders are likely to act together, liquidity exists. Price moves toward those areas because that's where transactions can happen. The market doesn't move randomly, it moves to where business can be done. The simple rule: liquidity forms at obvious levels. Here's the shortcut most traders never learn. If a level is obvious to you, it's obvious to everyone else. And that's exactly where liquidity forms. You don't need fancy concepts. You need to train your eye to spot crowded ideas. Liquidity type number 1. Equal highs and equal lows. Equal highs and equal lows are one of the cleanest liquidity signals on any chart. Why? Because they create confidence. Traders see price fail at the same level twice and think, that's resistance, that's support. I'll put my stop just above it. I'll trade the breakout. Both sides stack orders in the same place. That creates a liquidity magnet. Price doesn't avoid those levels, it seeks them. When you see equal highs or lows, don't think barrier, think target. Liquidity type number 2. Session highs and lows. Session highs and lows are another major liquidity source. London high, London low, New York high, New York low, Asia high, Asia low. These levels matter because traders anchor to them emotionally. Stops sit just beyond them. Breakout orders sit right above or below. That's why price loves to poke the level, run the stops, reverse, or expand. If you're not marking session highs and lows, you're trading blind. Liquidity type number 3. Obvious swing highs and lows. Swing highs and lows are where traders feel safe. They place stops there because it looks logical, it looks clean, it looks protected. But clean structure attracts attention, and attention attracts liquidity. The more obvious the swing, the more orders sit around it. Clean levels get raided, messy levels get ignored. Liquidity type number 4. Range extremes. Ranges are liquidity factories. When price rotates between a high and a low, traders get comfortable. They buy the low, they sell the high. They place stops just outside. Eventually, the market must break that comfort. That break usually starts with a liquidity sweep, not a trend. If you trade ranges, don't think in terms of breakouts. Think in terms of who gets trapped first. How to spot liquidity in 30 seconds. Here's the practical exercise. Zoom out slightly. Remove all indicators. Ask one question. Where would most traders put their stops? That's it. If you can answer that honestly, you've found liquidity. You don't need precision, you need crowding. Liquidity doesn't have to be exact, it has to be obvious. Why this changes your trading? Once you see liquidity, entries stop feeling random, exits stop being emotional, pullbacks stop scaring you, fake moves make sense, you stop chasing price, and start waiting for the market to show its intent. You let price run the stops first, then you trade the reaction. That one shift removes a huge amount of frustration. The big mistake to avoid: liquidity is not a signal by itself. Just because price reaches liquidity, doesn't mean you instantly trade. Liquidity tells you where price wants to go, not how it will react when it gets there. Reaction comes from structure and timing. Liquidity is the destination. Structure and timing are the entry tools. Final thought: you don't need to predict the market. You need to understand where traders are positioned. Liquidity shows you that. If you can consistently identify equal highs, lows, session extremes, obvious swings, range boundaries, you'll start seeing the market for what it really is: a constant search for orders. Once you see liquidity clearly, everything else becomes easier. Thanks for watching. Please like and subscribe.